Bitcoin has proven itself over the last 10 years. It hasn't been hacked. It's by and large, therefore, worked on an operational basis. It has built a significant following. It is an alternative, in a sense, storehold of wealth. It's like a digital cash. And those are the pluses. Bubbles are financial assets that have imputed value. It's an asset that doesn't have intrinsic value. It has imputed value. It's whatever we think it is. And if you look at some of the bubbles in the past, a great book is Extraordinary Popular Delusions and the Madness of the Crowds by McKay, 1845 or something. But he talks about the South Sea bubble, and he talks about the Mississippi bubble and so on. It is when people love it. It's the dot-com bubble and so on. So when you look at Bitcoin, it's a possibility. It's an alternative because there aren't many such assets. There are not so many assets that might have intrinsic value that can't be messed around. As far as the government allowing it, the history was, banks always used to exist. And then with the Bank of England, they decided that it was in their interest to have a monopoly on banking at a country. So every country treasures its monopoly on controlling the supply and demand. They don't want other monies to be operating or competing because things can get out of control. So I think that it would be very likely that you will have it under a certain set of circumstances outlawed the way gold was outlawed. And you're watching that question arise in India today. India today is making the move to outlaw possession of it. Now, can they do it? Now we get into the particulars. My understanding from people who are sort of in government surveillance and go on is, yes, they can understand, they can track it, they can know who's dealing with it. I don't know, I'm not an expert on that, but there's a whole way. Is it private wallets? Is it not private wallets? How do you do this, and the other thing? I would suspect it would be very hard to hold up against that kind of action. So that's what it looks like. A lot of new ideas, new technologies, new things come along, and they make fabulous revolutions, and they grow things, and that's great. But there's a tendency of investors to extrapolate the past and get and not pay too much attention to price. And when that happens, you start to emerge as somewhat of a bubble. By our measures, the bubble is not as what it was in 2000 and not what it was in 1929, but it's kind of like halfway there if I look at the types of qualities. In other words, and so what that means from a value point of view, if you're calculating, what can I realistically expect? Its expected returns shrink relative to the others. However, the kind of the meat and potatoes type of companies didn't benefit as much from those, and they're fairly stable and so on. And so that's why you're starting to see that kind of rotation. Now that can change. It can come and go in these phases, like when people get stimulus checks and then, they might be hot on, the exciting things and they run up again and so on. But that's going on. And of course, there's Bitcoin and other things that are going on. However, the big thing is plenty of liquidity and ridiculously low interest rates. Now, you ask about the 1.6%. I think we have been in a 40-year bull market in bonds. So now you look at that 1.6%. That's a negative 1% about real. Okay. So you're guaranteed. And you ask yourself, if you're going to hold a bond, any investment, the only purpose of an investment is so you can sell it to buy something you want. And so when you look at what is the length of time it's going to take me to get my money back.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now, let's continue.
If I give an investment nowadays in the United States, I'm going to have to wait about 50 years to give back the buying power to start, and then I'll start earning money. If I'm in other countries, some Europe and Japan, I will have less. And if I measured in all those countries in real terms, I'm going to have less money. So basically what that means if I just bought anything that didn't depreciate in real terms, if it just matched inflation, I'd be better off than to have those things. And so now, I don't think those rates will only stay down there, I think, if the Federal Reserve does what it did like in the 1930s in the war period, which is to put a cap on rates, to make short-term interest rates low in relationship to the cap. Like back in the 30s and the war years, they made 1% was the short-term interest rate and 2.5% was the bond yield. So it was profitable to buy those bonds, funding it with 1%, and you got 2.5%. That could put a lid on it. But because those two assets, cash and bonds, were such bad investments relative to other things, there was the movement to those other things still, and then the government outlawed them. I mean, things like gold. They outlawed gold. That's why also outlawing Bitcoin is, a good probability. And that they also established foreign exchange control because they don't want the money to go elsewhere. There are two types of inflation. Okay, let me just clarify. There's supply-demand inflation, like if demand is pressing up against capacity to produce things, and maybe that's labor, maybe that's capacity constraints and so on and so forth. Prices rise because of that. And then there's monetary inflation. And monetary inflation is because the currency and the value of money goes down. And so you can see, like in the 1970s, stagflation. You could see inflation is not coming from the first of those types of inflation. It is coming from the second of those types of inflation. And the way that would occur is because people don't want to own bonds. To me, it's pretty crazy to want to own cash or bonds. Okay, we can get into why that is. But if you have that movement out of like that type of financial assets to other assets, which we are seeing, then that has the effect first of causing financial inflation. In other words, an investor shifts it to another investment and they go up in value. And then that wealth effect has an effect on those items that people who acquire the money want to spend on. So maybe it's on penthouses or maybe it's on something else, but it depends how that's spent. I'm more worried about the monetary inflation, which would look something like a currency defense. It means that what happens is as money, let's say people don't like bonds, and then they start to sell bonds. And bonds then go down in value because they have a capital loss. And they don't offer anything in interest rates, negative real interest rates and so on. They don't like that. Then the Federal Reserve or other central banks are faced with the choice of either rates rise, and that is bad for financial asset prices and it's bad for the economy, or they make the purchases. They make money and they make the purchases of that. And that then produces more of a monetary inflation. So it's the second that I'm more concerned with. But the supply demand of debt will be, I think, the big driving influence. And I want to emphasize this because so many people say, okay, well, here, they look at this stock or they look at this. But what you saw was the V bottom in all markets and so on. And that was due to debt and money dynamic happening. So that's the biggest dynamic to pay attention to. I think it was April 8th or 9th. The exact same action was taken basically almost as happened on August 15th, 1971, which was also the exact same action which was taken on March 5th, 1933. In other words, the big jolt, the separation in terms of that value of money, that dynamic. And that is the new paradigm.
What to do in such a situation? Inform yourself and keep your financial education strong. We from the Compact Group offer our loyal subscribers a free educational portal with first-hand monetary, financial, and economic knowledge. Enter our invite-only Insider Club by clicking the link below. You will get access to first-class information far earlier than the rest. We have prepared a special deal for all our members where you can access a giant pool of Robert Kiyosaki's financial wisdom for just $1. To find out more, simply click the link below and join our Insider Club absolutely free. But there is more you can and should do. Build up several streams of income. More and more people realize that they have to take their future in their own hands, but they don't know how and where to start. We from Compact offer our Insider Club members unique opportunities. Strengthen your financial muscle and get the edge. Click the link below. Become part of our free Insider Club. No financial obligations. But there's one important thing you have to know. You have to become active. So do it now. Become active and see you on the other side.